What's up, everybody? It's Jamel Gibbs, your family-oriented entrepreneur. Welcome to another podcast episode. This is the Business and Investing Podcast, where you learn all things business and investing related. So recently, I've been releasing a lot of content on the infinite banking concept, along with the Heloc strategy. A lot of people don't know about this strategy, and I wanted to make people aware of this because this is the stuff that they honestly don't teach in school, right? A lot of us don't know about this because they don't teach it to us. So I'm going to be the one to assist in getting this information out to the world. And I want you to take this information and apply it into your lives, apply it into your businesses, apply it to creating generational wealth. Apply this information because without application, nothing works, right? So, like I said, we've been on these infinite banking podcast episodes, and if you haven't had a chance to check out the first two episodes, make sure you go back to the first and the second episode where I had my guest on, D'Andre Clayton, and also on the second episode we had Reggie Briscoe as well. Now on the first episode we jumped into the IBC concept in detail, the infinite banking concept in detail. On the second strategy we jumped into how it applies to HELOCs and real estate. Now, on that second episode, I told you guys that we were going to have an opportunity that we were going to present to you guys in order to allow us to assist you in getting this concept set up properly and profitable, and possibly even have an opportunity to partner with me in real estate deals from the private money spectrum, if that's something that you guys are interested in. And that's something that we'll talk about later on. In this particular episode, D'Andre and I have something special that we want to mention that we believe is going to help a lot of people. And in addition to that, help you become profitable in your businesses. But today we're going to talk about the infinite banking concept, how the HELOCs apply. We're going to recap that stuff and how it all applies to real estate. But more important than all of that, we're going to talk about how all of this is kind of like playing Monopoly in real life. So what we're going to do is use some Monopoly cards and talk about how those Monopoly cards apply to this concept and you creating wealth in real estate. This is completely different than anything you've ever seen. How does infinite banking and real estate tie into Monopoly? And we're going to show you in real time how that all works. We're also going to show you an example of a policy, and you're going to see how those numbers can grow over time based off of the policy that you choose for yourself and what you can actually do with the money. This is powerful stuff, man. I mean, if you agree that this is powerful, do me a favor, leave a comment in the comment section and just let me know. Just say powerful in the comment section. Make sure you like this video if you're watching this on YouTube. Subscribe to this channel if you're not subscribed already for more videos just like this. If you're listening to this on the podcast, make sure you share this with the entire podcast world so that more and more people can have the financial literacy that they need in order to create that real generational wealth that people are looking to create. All right? Not enough people are doing this. Not enough people are in the know. And if it's the last thing that I personally do, I want to make sure that you're in the know so that you can help change your family's circumstances. All right. This is information that wasn't readily available to me growing up, and it wasn't readily available to anyone until recently. So these are things that we're going to talk about, and this is something that I'm becoming a true advocate of because I truly believe that this concept can change lives. So if it can change lives and it ties into real estate and you can be your own bank, then I'm all for it. And let's make this happen. But listen, we're going to jump into all of this stuff today. A lot to talk about. We're going to be talking about an opportunity. Make sure you watch this until the very end. We're going to cover a lot of meat on this podcast, but we're also going to cover that opportunity for you. D'Andre Clayton, what's up, my man?
What's going on, my man? What a wonderful introduction, man. I was feeling like the revolution will be televised today. Thank you so much, man. Yeah, I'm really pumped to share this information today. Really, it kind of came up from a sense of just wanting to simplify it as much as possible for people. Because, since the podcast, I've gotten tons and tons of inquiries from all of the wonderful individuals who have visited, for sure. And, sometimes they don't know exactly what's going on. They don't know really how to differentiate between cost and value. And, we're going to get into it today so that they have a better understanding by the time this is done of how to get started, what they need to do, and what lies beyond once you get one of these bad babies set up.
Let's do it, man. I'm looking forward to it. So, just for the listeners who are watching us for the first time, obviously we've covered this in 2 different episodes. What is the infinite banking concept? Like, just give us a scratch of the surface idea of what it is.
Okay. So the infinite banking concept is a concept that basically takes a whole life policy that is structured in a way to not necessarily eliminate all of the death benefit, but take a significant chunk of the cost out of it so that it redirects it towards a bank inside of the insurance policy. And then it allows you to basically live off of the loans from it because the loans are very, very cheap debt. And it collateralizes that with the death benefit. And so, realistically, the reason why it's infinite is because the growth of the money never stops going because you're never actually withdrawing. You're always taking a loan against. And so that's what makes your money always grow no matter how much you're actually using your money.
Got it. Got it. Now, how would this tie into the Heloc strategy? What makes that so effective?
So, what makes it effective with the Heloc strategy, based on our last episode with Reggie, is that, what he did was he basically got a first lien Heloc. He was able to put all of his income or his cash flow into that Heloc, which then destroyed the interest, right? And because it destroyed that interest, he's able to effectively pay off a home significantly faster. But while it's doing that, he also has it as a revolving door, a revolving line of credit. So he's able to actually use those funds to do whatever he may need to do, which is very, very favorable. So that's really what's going on with that HELOC. So when you combine the two, you get something special.
Got it, man. So now, obviously, all of this ties into real estate investing as well, because when you, let's say, for example, you use the HELOC in order to fund your whole life policy, in order to borrow 90% of that out for your infinite banking situation, you can use that money to purchase more real estate. You can use that money to do private lending in real estate if you don't want to be hands-on. There's a ton of other things you can do. Now, for those of you who are interested and again, I'm just plugging this right now, but I'm going to talk about this in more detail. I'm consistently growing my real estate business. It's been 20 years, but a lot of what I do is through creative finance and also private money, right? So if you're in a situation where you are looking to get started in real estate, or you want to make money in real estate, but you don't want to be hands-on, and you want to work with somebody that's experienced like me, for example, we can have a conversation on how we can use this infinite banking concept in order for you to be able to make money in real estate while my company does majority of the work, if not all of the work. So that's just an opportunity. If you guys want to hear more about that, do me a favor, in the comment section, leave the remark opportunity, right? Again, just like the last one, the opportunity to do this video. You wanted to hear more about an opportunity. This is one of them. But this isn't the big opportunity that D'Andre and I want to talk about. But if you want to see how you and I can partner in that respect, if that's something that you're interested in and you want to have a conversation, do me a favor, go ahead and reach out, so that what I'll do is I'll reply to your opportunity post so that we can get in touch with each other. And you can, at that point, go ahead and set up a call with me so that we can talk about how this can be beneficial for you. All right. But there's another opportunity that D'Andre and I wanted to talk about if you're interested in doing this all on your own, and if you're interested in learning more about this. But before we get into all of that, why don't we show our listeners a real time policy, or at least an example of one that can help them to grasp how the numbers work. Then we're going to talk about how this all ties into real estate and turning this into real life Monopoly by showing them the cards. That's cool, man?
Gotcha. Sounds good. Sounds good. Let's go. Let's go. All right. So I want to show you. These are now. This isn't necessarily personal information because Jamel's name is actually at the bottom, and it's also the name of his channel. So this is just an example of what a policy could look like on someone like Jamel, for instance. Which right. So I want you to notice that there's two different policies here that we have. So we have one of them that is from a company called Mass Mutual, which is a 10-year policy. So now this 10-year policy, I want you to notice something really, really interesting about it. So it's structured as close to a 90-10 as possible, right? All right, so what you're looking at right now is a policy through one of the four kind of large mutual companies that really is super powerful for the IBC concept or the infinite banking concept. So this is a quote, just a kind of simple quote I ran on Jamel, and I want to show you the power of what the IBC policy is doing here. So as you look in the top corner, it's talking about the first year, and normally the year will be, the next date of your birthday. So you'll see 42. He's not actually 42. He's 41. But when you look at it, you'll see that he puts $100,000 in. There's $83,722 that is there in year one, right? Now that's what he can borrow from. So let's say Jamel puts that $100,000 in immediately. He has $83,722 that's already available. Now, as he goes through year to year, you're seeing a growth here in this area where it talks about the net annual cash value increase. But the incredible thing about it is,
Now, 1 second before you
go ahead.
1 second before you get into that, D'Andre. So, some people might ask, okay, if I put in $100,000, why do I only have
All
$83,722
right.
available?
That is a very
Can you
good
explain that?
question. Yeah, that's a very good question. So, as I mentioned, normally our goal is to try our best to structure it as a 90-10. There is cost associated with creating a 90-10 as well. So, as you're looking at the amount of term that is needed so that it stays within the regulations of making sure that the policy doesn't blow up, that is why that amount is there, because you're going to have to pay for a little bit more term insurance in order to facilitate how big the bank is on these policies. Does that answer your question, Mel?
Yep,
All
absolutely, man.
right. So now on these policies, what I think is just incredible when you look at this particular one, because it's kind of structured that you only pay in for 10 years. Now, what you probably heard is that life insurance policies, you got to pay them for life. You probably never heard of one that you could actually be fully paid up in 10 years and actually start drafting money from it that is astronomical. So in this case, after a 10-year period, what it would allow Jamel to figuratively do is when you look at this number right here, it's going to continue growing from year to year. So the passive income on it is $56,871 year 10, year 11, right?
Now, pause right there for a second. Pause right there. So, just for you guys listening, let's just say, okay, I'm 41 now, and that's my real age.
Mm-hmm.
By the time I'm 51, putting $100,000 a year into this policy, And we'll talk about how you can come up with $100,000 as well per year. But the $100,000 per year will ultimately create a $3.5 million insurance policy, a payout for my family. But in addition to that, just like buying real estate, this is why this is so powerful. We talked about how this all ties into real estate, right? If I never touch the money, I don't need the money. Guess what happens? You see that $56,871? That's passive income. How many people are working right now for a $56,000? The average, the average person in America right now, right? How many people are working for $52,000 a year? The average person in America makes $52,000. Now, obviously, I'm aware people make more, people make less, but that is the average.
With taxation.
$52,000 as of with taxation.
And they got to deal with the tax.
As of right now.
Yes.
That's right. Now, check it out. This $56,871 is tax-free passive income for me. It continues to grow onto the policy. So what happens after that? No, one more thing before we even get into that, D'Andre. Well, you know what? Explain this first, and then we'll talk about how they can come up with the money to keep funding it. Because a lot of people are thinking, hey, I don't have $100,000 a year to put into this thing. How do I do that? But let's talk about the benefits of this. Then let's tie it into how they're going to come up with the money. Okay.
Okay. So the benefits of this, and I want to make sure this is also clear before we really go beyond year 10, is that although we're focusing on this passive that's going to continue to grow, every year that you see before that is the increase in the portfolio from year to year. Those are increases in the portfolio. So the cumulative is right here on the left side, what you're seeing here, right? So that $1,147,212 is sitting there in year 10 is tax-free money that you can borrow against already. So now after year,
why is it tax-free?
Because you're taking loans against it. So you're taking loans against this $1,147,212 number, and then what makes it against on top of that is that this is what collateralizes it, the death benefit.
Now check this out, everybody. This is if you've been watching my channel for any amount of time, I use real estate leverage to be able to purchase more real estate, right? I spoke about one of them earlier, being in private money. That's leverage to be able to buy more real estate, right? When you borrow money, let's say you're using a BRRRR strategy. I explained this on a previous video. When you're using a BRRRR strategy and you do a refi cash out, you do not pay money or you do not pay taxes on the cash out because it is considered to be a loan, right? So with the infinite banking concept, it's the same exact concept. When you think about it, you're living off of loans. But now that may not sound conventional to some people, but this is a powerful thing because on the day of your death, you see that number right there? Which number is it, D'Andre? On the far right?
Far right.
Of the screen?
Far right.
That number covers all of the debt that you picked up, and the difference goes to your family.
Yep.
It's an incredible, incredible policy.
Yeah.
Right? So I just wanted to clarify that real quick.
Yeah. Now, this one is structured pretty cool because once it finishes out at 10, that's when you're finished paying it off, right? So most of us, we think about retirement as kind of a 30-year thing, right? We save for our retirement for 30 years. In this example, you're saving for retirement in 10. And not only are you saving for retirement in 10, but you're able to draw it before 59 and a half. You don't have to wait till 59 and a half to be able to gain access to what this column is doing every single year. So
like an IRA, you got to wait until you're 59 and a half.
Wait till 59 and a half on the IRA. So it's growing by this much every single year for the rest of your life, and you had a 10-year commitment where you put that money in.
Now show me some of the numbers at the bottom.
So numbers at the bottom, that's where it gets excited about, right? So for instance, here at conventional, you talk about Medicare age, right? So Medicare age, you would actually be receiving $103,821 tax free into that account. And as you see, there's I want to also explain, because some people might see, well, why did the death benefit drop right here? I also want to
Right, and then
explain
it's
that.
picking back up.
So the death benefit dropped right here because your premium dropped. So you don't have to pay for the term either. So because you're not paying for the term, it's no longer on there. But the way the policy is actually designed is that it will grow because of the window of how much cash value is there. So you really get to see how lean it is on the death benefit side when you're seeing, oh, I have $1.2 million in here, but it's about 215, but it only got to 215 or 150 because it was able to grow over time to that 1.2 instead of starting off at 2 million, right? So that's the beautiful part about it. And then what happens is it continues to grow as you look, and as you continue to get older, not only are you having a cash benefit that continues to accrue, but you're also having a death benefit that continues to accrue. So the more and more loans that you have out, the more it's collateralized.
And it keeps going.
Yeah,
It keeps
it,
going.
it,
If you just
it, it
scroll
keeps
down a little
going.
bit more,
It keeps going.
it just
So 67,
it, it
68,
just keeps going. Look at the
69.
numbers.
So this is what I call a life insurance policy, right? This is
Right.
what life insurance actually was designed to do at its inception. And I want to make sure that that's very clear, because as we talk about real estate, we talk about life insurance, we talk about HELOCs, that is the real traditional that existed in the world before we got to mortgages, before we got to 401ks, before we got to IRAs, before we got to mutual funds. There was life insurance, there was HELOCs. Wasn't called HELOCs, it was just a mortgage then, but the mortgage was structured like a HELOC, and there was real estate. That was how people got wealthy. And so, as you look at the inception of what we're going to talk about later with Monopoly, the original Monopoly was called Landlord's Game. Landlord's Game came out in 1904, 1902. At that time, there was no other investments besides real estate and life insurance. There was no
Real estate.
401ks. There was no
Yep.
none of that. So,
There was no
there was
Bitcoin.
no
There was
Bitcoin.
no stock market.
None of
The
it.
stock market was still there, but
In fact,
well, before that, real estate was in.
just to take you one further,
And that's the whole point, man. That's the whole point of the whole thing, right? So real estate
right,
is a time-tested, proven investment strategy.
right.
Buying whole real estate specifically. So we all started off flipping houses and wholesaling, right? That's where you want to end up,
It,
right? That's the play for real estate. Buying whole. That's why I preach buying whole, generational wealth. This is how you do it, folks. If you listen to me, you'll get somewhere with, and especially with the information that we're providing,
yeah,
right? You'll get somewhere with this information. You just got to be patient, and you got to incorporate these steps. But before you even get into it, D'Andre, look, the average person in America lives until they're about 78 years old, right? That's a fact. You could Google it. The average person lives a little over 78 years. Now, some of us live longer, some of us live less, right? That's a fact. But on average, the average person lives about 78 years. So if you look at that line, 78, how much money am I making when I'm 78 years old just putting $1 million into this policy over 10 years? $181,000. How much does the average person make when they retire from their job? The average person at $52,000 a year is making how much? About 80% of that money you should be making. 80% times, so you're making about 40 grand a year until that money runs out,
if that,
right?
yeah,
This continues to increase, $181,000 by 78 years old. Living large. That's what we want to do. That's the power of this thing, right? And it all ties in. And this is not including the real estate. This is not including any of that other stuff. This is just this. If I died when I'm 78 years old, my family is getting about $5 million just off the rip because I have this life insurance policy. So that pays up everything that we've acquired in debt. And it allows my family to, let's say I got a $500,000 in debt. I don't know. When I'm 78 years old, that's a lot of money to have in debt when you're 78, right? But let's just say it's $100,000. The $100,000 gets paid off, and the difference goes to the family. So what you should be doing is setting up a policy for everybody in your household.
Every last person.
All your grandkids, everybody that's a part of your family should have one of these policies. These are different banks, different entities that you can use in order to capitalize from. And y'all can capitalize as a family. That's how the Rockefellers did it. Right?
Yeah.
But let's get more into it, man.
Yeah, and I also want to point out too, when we talk about 65 or 60, it's important to note that when you look at any statistics, there's a measurement or projection that Social Security won't be around soon. Right? That there's a possibility that Social Security won't be around in 2034. So if
I ain't relying on no Social Security check.
you ain't relying on Social Security check, but here's another tidbit. When Monopoly was created, Social Security did not exist. Social Security did not exist. So Monopoly was created under the guise that there is no other financial vehicles. There's only real estate and there's life insurance.
That's powerful,
Most
man.
people don't want to admit it,
That's something I didn't know.
but
I didn't know that, man.
that's the
So
reality of what was going
that's
on.
crazy.
That's the reality of what was
Yeah,
going on.
man. So this was the original retirement plan
This
for
was the
people if you
original
wanted to
retirement plan.
go out wealthy.
Yeah, yeah,
Love it, man.
yeah. This was the
So
original.
these numbers continue to grow as long as you live, and the benefit, you notice the benefits, the death benefit continues to grow.
Yeah,
Your income continues to grow. This is like this is compound interest on steroids.
this is what it is. This is what it is. And it's uninterrupted because you're not withdrawing, you're taking loans,
Right.
right?
So explain that. I know
So
we explained it before, but explain that for
so
everybody in the back.
so in simple terms, if you think about your bank, your regular bank, when you put money in, your balance changes all the time. Your balance goes down, it goes up, it goes down, it goes up because of your bills, because of everything that you have going on. In this example of taking loans against the cash value, your balance never goes down. Because it's never going down, it has a consistent growth on the interest. So,
Let me simplify that for him, bro. One more thing, and you know, I'm excited about this. If you
yeah.
guys can't see it, DeAndre's the guest. I'm doing a lot of the talking, but look, I'm excited about this.
Nah, it's
I need to
awesome.
simplify this because this is some powerful, powerful, powerful stuff. Check it out. If you go to the bank, right, and you borrow, let's say $10,000 from the bank, right? You're taking out a loan. But rather than you going to a local bank, you're going to borrow this $10,000 from yourself. The whole life insurance policy is going to pay this back on the day of your death. So in essence, what you're doing is you're taking $10,000 from your own personal bank that will be paid back through the whole life insurance policy. So you're never taking money from the policy. Am I right, DeAndre?
Correct.
You're never taking money from the policy.
Correct.
You're borrowing against the policy, and all of that money will be paid off. And like I said before, the difference will go to your family. Is that about right?
That is correct. It is never a withdrawal, so therefore you're never taking money out of the policy. So if you think about any other investment that
Powerful.
you have today, you got a 401k, you got an IRA, you have mutual funds, whatever you are taking money from, you have to deal with the loss of opportunity of the money you took, right? So
Yep.
so if I took 20,000 from my 401k, not only do I have to deal with the taxation, Not only do I have to deal with the fee, the IRS penalty, but I also have to deal with the fact that that 20,000 no longer can gain whatever the market went up to.
You know what this is like, man? This is like almost like having a secured credit card when you think about it, because you got to fund it,
Mm-hmm.
and then you borrow against the secured credit card. But with the secured credit card, the money is still technically there,
Mm-hmm.
but they're giving you a loan against the money that you have in the bank,
Yeah. Yeah.
right?
Yeah. And
Incredible, man.
you know, and the cool part about it too is, so you're going to have situations when you're investing, and as I always say, the main thing you want to make sure you do is pay the interest on the loan. But as we talked about in our last, conversation, the interest on the loan is negligible because it's only charged once a year. It's
Mm-hmm.
simple annual interest. So if that interest is paid on that loan, you are able to continue trekking, pumping the policy just the same way that you were able to pump it, and still continuing to open up the amount of space that you have to loan from, right? Now, here's the other cool part about it. Some of these people have been running up on me. They say, well, I don't know. I got 20K, but I don't know what happens when I have 50,000. What can I do with that? Well, you can even structure these things to have extra space to be underwritten from a term standpoint, so that when you got extra money, you can throw it in. But you just have to be
Mm.
intentional about what your desires are up front with how you want to structure these things. Now, here's another aspect on this particular policy that I know somebody like Jamel would love that we didn't even talk about. So at year three kind of marks a special year for you, because once you get to year four, you're able to increase the premium by 10% every single year until year 10 is finished.
Mm. That's crazy,
So
man.
now those numbers, these figures will look completely different as far as how much money you would actually have in that bank, being supercharged, really being able to live whatever type of life you really want to live.
Now, quick question. We covered a lot so far. A lot of people are asking, how am I going to fund $100,000 a year? How would they fund their policy? I'm not saying that you guys have to come up with 100,000 a year,
Right.
but let's say that your amount is 20,000 a year. How would you fund that?
Okay. So, first and foremost, I want people to understand something about how these policies are structured. So, when you understand that what you're looking at is a percentage, so if you're looking at 100,000, so the 100,000 is the total that the premium is, but then you're looking at what the in cash value is, which is $83,722. I want you to understand that that is an indication of how much the policy actually costs. So let me back up. The policy itself actually costs the difference of that. That's how much the insurance itself costs. So when we're structuring 90/10s or 80/20s, because sometimes due to term costs, we may need to structure it as an 80/20, but the general person you're going to come across is only going to structure 50/50s and 60/40s. I'm going to be very honest with you. I have a number of different business ventures going on, so I'm not here for the commission. I'm here to partner with you and do other business ventures where we can make a lot more money than the amount of money I'm going to make on the commission on an insurance policy. So that's first and foremost. I'm just going to go ahead and be very honest about that. But when you're looking at it, there's a minimum that's due. So the minimum that's due is the difference between this number and that number. That's the minimum that's due to even have the policy, right? So that's a much different number than what you're seeing over here. But that's what helps you understand just how much you're banking. So your mindset has to really, really change when you look at this process, because if I'm giving you a 90/10 or if I'm giving you an 80/20, imagine you paying $100 for something and I give you 80 of it back and I still give you the product. Imagine you paying $100 for
Like
something, and I give you
like paying
90
20
of it
cents on
back.
a dollar for it.
Yeah, and I give you 90 of it back, and you still get the product, right? That's what's going on with infinite banking. So when you ask about, okay, well, that's $100,000. $100,000 is just a round number, to be frank with you. But when we talk about, okay, can you structure it for $20,000 a year? Yes, you can. Can you structure it for 30? Can you structure it for 10? I have clients who are structuring them with $800 a month coming out, right? So there are clients who are structuring it as less than what this huge figure is. This figure is just easy for you to see the numbers work out. So I want to make sure that that's clear as well. But the importance of it, go ahead. I see you about to say something.
Yeah, no, I was going to mention. So you have to remember that as this policy grows, you have access to more capital to help you make more money
Yeah,
at the end of the day,
yeah.
right? So the $100,000 that you start with, or the 20,000, or the 1,000 that you start with, or whatever the case may be, yes, you have to pay that out every year. But technically, this is not necessarily coming out of your pocket every year. Is it, DeAndre?
No, so you have different options that whatever the growth is, you could actually use the growth of a previous year to pay the year that's ahead of you because you're struggling. There's a number of different
See that?
there's a number of a variety of ways to be able to make sure that you stay on track. Now, of course, the performance won't be as strong, right? Because it's not going to be as much money in there, right? So you have to think about it like literally there's a banking portion in there, right? So if you understand that this is not just a life insurance policy, and to help you understand it's not a life insurance policy, we have clients that when they request 20, 30, $40,000, it's in their accounts in 12 hours. It's electronically drafted from the insurance company in 12 hours. Where else are you going to do that?
Yeah, man. Yeah, you can't.
Right?
I mean, you got to, especially like a house, for example, is extremely illiquid, right? So what that means is you got to go through a whole process with the bank to be able to
Mm-hmm.
qualify, to be able to pull money out of your own house.
Mm-hmm.
The leverage is there, the equity is there, but with something like this is extremely liquid.
Extremely.
This is better than the S&P 500 in my opinion, you know?
You know what? I'm gonna be honest. I'm a fiduciary. I agree with you. Um, of course, we have to make sure from just a disclaimer. These are not called investments, and I want to make sure that that's clear to you guys. That when you're talking about life insurance, the reason why it's not called an investment, and I want to make sure this is really clear, is because it can't lose money. That's why.
Mm,
It's not because it isn't valuable.
mm.
It's because it can't lose money. So we in this nation, we have gotten into the habit of thinking that the opportunity to lose is always, it makes it more valuable. That is not how everybody feels. That is not how wealthy people feel all the time. They want to, if you listen to Warren Buffett, he says the number one rule, don't lose money.
That's
But the
right.
vast majority of people, they hear high risk, high reward, low risk, low reward. We've been programmed into believing that that is how life has to be. But there was a time when the risk didn't even exist. All of the investments that you see today were not around when this was around.
They were created by banks who are designed to charge you fees and take your money at the end of the day.
I'm just
So why
being
not be
frank.
your own bank? I can say certain things that you can't, bro. I'm gonna
That's
say
true. That's true. There's certain things I can't
it.
say.
I'm gonna say it. You know what I mean?
Yeah, that is
But
true.
at the end of the day, man, this is a powerful, powerful way. And obviously there's a lot more to it. I wanted to show you guys in real time what numbers actually look like. And these are generic numbers based on a policy that I'm looking to set up. But what I'm saying is, these numbers, don't let these numbers scare you. $100,000, you can actually live off of the policy, and like you said, the difference in the cash value that you have can fund the policy for that year, can it?
Yeah, yeah. So yeah, it
You
definitely
know, so
can. And once again, what is required when you're funding the policy is what is it, there's a minimum that's required, and the minimum is what is required to set up the structure, right?
right.
So if we're looking at what is required to set up the structure of this policy, you have $100,000. You subtract 83,722.
So it's about
That's the
16,003 and some
requirement.
change.
That's the requirement to fund, right? But
Right.
you have the ability to put a full 100,000 in here. But you want to now, if you wanted to perform like this, yes, you put $100,000 in there, right? But if you want to have the down years where you're like, hey, look, I don't know if I got it, which I don't really understand that concept too much, because if you're looking at and if you're utilizing the money, because we need to highlight this very much so, you will not have a down year where you don't have the money to pay the premium if you're utilizing the money.
Because you have opportunities. Again, you could partner with me, private money.
Right.
You can buy more real estate. You can flip houses with this money. So again, you should be using the money
You
in the
should be
policy
using the
in
money.
order to grow your income.
Absolutely. Absolutely. You should be using the money. So if you're using the money, you won't look at the sticker and say, oh my gosh, I don't know what to do, because you'll realize that, oh my goodness, I have access to $83,000. How can I use $83,000 of the insurance company's
To
money?
make more money.
Right?
That's right, man.
That's how you're
It's
supposed to think.
insane. That's crazy, man. So how does all of this tie into Monopoly?
Okay, Monopoly, Monopoly. So, how does it tie into Monopoly? As I mentioned, Monopoly and its origin, it only had two different financial or a few different financial ways to go about life at that time. And Landlord's Game, Monopoly, all of it, it is really a structure for teaching you buy and hold. That's all Monopoly is about, right?
Mm-hmm.
Buy and hold real estate. That's what Monopoly is about. But there's some different things going on in Monopoly that most people probably have never thought about, as far as how it could relate to combining infinite banking, how it could relate to
Yeah.
combining the Heloc strategy. So, what we're going to do is we're going to share some of the action cards of what Monopoly is. And my man, yep, hey, I keep the box on deck. And I tell you, all of you should be going out purchasing Monopoly. If you see this, Monopoly deal will help you to understand financially how you need to be moving. And we'll definitely,
Matter of fact, I'm gonna link. I'm gonna provide a link for
the
these
Amazon link,
Monopoly cards and where I purchased them in the description
you
box. I'm
need
gonna
to.
leave it in the description box for y'all to check it out.
One of the greatest games ever, and it doesn't take 10 hours like a regular game on Monopoly. You can get it done in 15 minutes.
You
Sometimes
know what's
20,
funny, man?
just depending on who's there.
I always win.
Well, I would don't play with a real estate investor.
I'm DJ Khaled in this game.
Yeah, we the best.
All we do is win in Monopoly.
That's a fact. That's a fact. So, what I like to highlight as far as why Monopoly is such a good baseline for understanding how infinite banking could be so important, how the Heloc strategy could be very valuable for you. First and foremost, the most dangerous card, the card that everybody hates to see coming, is this purple one. It's this purple one. This purple one called Deal Breaker, right? So you could be doing good, cruising along, and then a deal breaker comes out and everybody starts shaking. They don't know who it's for. They just know that if they don't have a just say no, it's a wrap. They know something bad is about to happen. But the reality is that, when we look at life, man, life itself has so many deal breakers in it. It has so many different things that we could lose everything or it could cause a tragic loss to us. So rather it be right now, market going crazy, dropping, people losing hundreds of thousands of dollars just in that, right? That's a deal breaker for many people. In 2008, there were people committing suicide over that deal breaker. That's a serious thing. Or it could be illness in your family. Illness can completely take away a retirement, right? I mean, people could lose all types of money when it comes to having an illness. Or it could be massive inflation, as what we're going through right now. It could be the banks giving away loans that they don't really have the money to fund. We've seen that, right? Those are deal breakers. All of these are deal breakers. Or even a loss of the person who's the main provider in the household. Those are deal breakers. So how do we just say no to them? That's the question, right? How do we make sure that no matter what's going on, that we have a defense or we're not terrified when a deal breaker comes our way? Well, I like to say my favorite card of the whole game is probably the card that most people don't think is worth that much. It's the pass and go card. And the reason why I love the pass and go card so much is because no matter where you're at, when you lay that bad baby down, you're getting a 2-for-1. You're dropping that card down and you're getting more value than what you put in. And when you get that value, you find out how you can strategize. A lot of times, when you drop a pass and go card down, that's when you get that. That's when you get a wild property. That's when you get a deal breaker to use on somebody. That's when you get a debt collector. That's when you get these rent cards because you don't know which way to go, or maybe you don't even have any property. And the pass and go card, oh, it landed you 2 boardwalks. You have no idea, right? But the pass and go card sets up every move after it. It just continues to set up every move after it. And it gives you multiple chances. And that's the beauty of the pass and go card. Doesn't that sound like infinite banking?
Absolutely, man.
Doesn't it sound like, oh, I get to use somebody else's money, not mine? And then you collateralize it with the death benefit? Oh, snap. That's wonderful. And so once you get into that infinite banking bag and you're like, okay, I want to invest in this, I want to invest in this, you're not as afraid of your investments simply because you're using the insurance company money and you know that the collateral isn't your house or your car. You know that the collateral is something that the insurance company gave you as well, which is the death benefit. That's what makes that so cool. That's what makes the pass and go cool. That's what makes the IBC concept cool. Now, the other card that people absolutely love is the wild property card. So the wild property card, if you're nearing your end to wanting to go out and really go out in a bang, or if you're trying to make sure that you got that flexibility that whatever it is, you about to hit some people with some rent cards or whatever, you want a wild property card because it could float anywhere. It could become a park place in a second. It could become boardwalk in a second for you. And then all of a sudden you hitting people and you getting all types of rent from them from a wild property card. Or it can just finish a set and have you to finish the game. Right? The Heloc is very similar to that. Because what you're doing is you're leveraging the value of your number one property. And you're saying, this is in first lien position. I'm putting all my income into this thing. And guess what? I can go get another property with it. I can invest in a number of different things. I can put this anywhere. Right? That's what the wild property is doing for you. So the Heloc really becomes your wild property. Now, together, when you got a wild property card, when you got infinite banking, they equal this. They equal your just say no. They equal your just say no. They create a synergy that no matter which one of these cards you see coming for you, you're able to say, inflation? What I care about inflation for? Did you see what those numbers were when we just ran them? He was 56,000, year 11, 59 next year, 60 something next year. That's beating inflation. And it's doing so in a tax-free fashion. Oh, but I got my wild property and my house is worth $400,000. And I also can go in and out of that bad baby and use the money out of that as well. So what type of problems can come my way that I can't handle from a financial perspective when I'm infinite banking and when I have a Heloc as my source of income as well, but I'm able to just stuff my actual cash flow into it. Now, why is this so awesome? Is because we're all going to get hit with this. Yeah, that is your birthday card. That is your birthday card. Come out, everybody giving up $2 million, right? So the is your birthday card. All it is inflation. That's our normal inflation, about 2%. That's our normal inflation. Now, right now, what we're going through is deal breaker inflation. It ain't regular inflation. But even if you wanted, even if you had the it's your birthday card, if I got enough of these, enough of the cash created from my wild property, created from my accruing different properties and cash from my pass and go, I don't care about giving you money. I don't care about giving you 2% because I'm definitely not going to give you the just say no card. I'm not going to give you the just say no card when the amount of money you asking for is just 2%. Now, when it gets terrible, like, the market right now, and people lose 50, 60% of a portfolio and they're wiped out, whether it be Bitcoin or whatnot, that's that deal breaker. That's when you're saying no, right? That's when, I can't take that loss. You wouldn't have to take that loss if you was using the insurance company's money. You wouldn't have to take that loss if you knew that over the course of time, you're always going to have tax-free income coming in for the rest of your entire life. And you can touch it before 59 and a half. So that's what we're talking about. Now, the cool part about it is really you could break down these cards in so many different ways because of what we go through. When you look at a rent card, you could talk about how rent, it gets charged based on class. So if you go to one neighborhood, that's how they run comps, right? You go to one neighborhood, everybody gonna have the same type of payment. That's what the rent cards do. Everybody get hit with the same thing. You can take control of the rent card by owning your own properties. You can make sure that it don't hurt you that much when you own your own properties. And you got a no card, right? Now the slide deal, it's interesting because the slide deal for many people, we could talk about like eminent domaining and different things like that. We could really get into that bag where people are just getting their property straight up taken from foreclosure, all types of things. Can you go into foreclosure? And I challenge anyone. Can you go into foreclosure if you are cash flowing your Heloc with your income? Is foreclosure possible? Can your property be stolen from you? No. So what they're going to have to do? They're going to have to force deal you. They're going to have to give up something for you to give it up. And that's how a lot of real estate agents really make the most money. They put a home somewhere. They look at, what's going to happen in the next 5 or 10 years. Walmart comes up, says, "Hey man, I want to plant this right here." All of a sudden, it's like, "Oh, you're gonna have to pay a lot of money for this," and Walmart got a lot of money to pay for it. Forced deal.
And and that's kind of what I was telling you the other day in regards to that business meeting that we're going to later on today,
Right.
in regards to meeting people from the city council and all of that stuff.
Right.
Just kind of being in the know of what's going on in your city in advance.
Right.
So I can purchase properties in those areas. Now, there's a certain term called opportunity zones, which has nothing to do with what I'm talking about. But I look at those as opportunity zones. If I know that they're going to build businesses in certain areas, I'm going to be in those areas, watch the values go up, then I could cash out of those properties later on. It's a buy and hold strategy. You know what I mean?
Yep. It's a buy.
And obviously, there's a lot we can cover with these cars, DeAndre. You know what I mean? There's a lot we can cover.
Sure.
A lot to talk about, a lot of detail that DeAndre and I can go into, and that's what our intentions are. Right? I hope you guys gain value from this particular podcast episode, but we're talking about something even bigger than this, right? We're talking about presenting you guys with an opportunity to come see us live for maybe 2 or 3 days during the course of a weekend, to be able to dig deep into infinite banking, to be able to dig deep into the Heloc and how it all ties into real estate and how you can partner on deals with us and things like that. If you're interested in seeing an opportunity like this come to fruition within the next month or two, maybe the next 3 months, something like that. If you're interested in seeing something like that, it won't be a free event. It will be a paid expense event, only because there's going to be expenses involved. But it's also going to present the opportunity to work with us. If this is something that you're interested in seeing, do me a favor, leave a comment in the comment section and just type in event. And based off of how many people comment event, we'll know if we should structure this or not. In the meantime, we are going to continue to provide infinite banking, real estate, and Heloc concept uh, information for you under my infinite banking playlist on my channel at Jamel Gibbs, obviously on YouTube. If you're listening to this podcast, make sure you check it out. Um, if you're listening to this on iTunes or anywhere else. But the whole point is we want to continue to provide you with the information. And for some of you, there's a small number of you that's going to want to take it to another level and actually take action with it. And if that's you, then we're going to provide that extra step for you to be able to work with us personally, more hands-on, to be able to take your business to an entirely different level. All right. This is something I'm implementing. This is something DeAndre does. And I want to see all of us continue to win together. We're going to be a bunch of DJ Khaled's out here. If you want to check out this Monopoly game, leave the link. I left the link in the description box for you. Make sure you check it out. Use that link. That's a direct link that's going to support this channel. And honestly, I want to do this live event. I want to do the workshop. I want to meet you guys face to face. And if, again, based on your interest in coming to a live event, we'll start structuring things and then let you guys know about it on the next podcast that we decide to do together. But leave a comment in the comment section whether you want to do it or not, right? Let us know what you've learned today, because all of us have picked up something. All of us can see how the infinite banking concept ties in with the Heloc, ties in with the real estate, all ties in like Monopoly in real life. This is like playing Monopoly with real cash, like Jay-Z said. It's like playing Monopoly with real money. And if you want to play Monopoly with real money, then you need to be at this event. So we're looking forward to working with you guys. I hope you guys enjoyed today's podcast. Be sure to like it, subscribe, share, and make sure you tune into the next one. We're going to dig a little deeper into this entire concept. Any last words for our listeners, DeAndre?
Really, I got to be appreciative not only for your platform, but really the amount of people who have been checking in on my website. Clayton Financial Solutions has been astronomical since the podcast. And I apologize for anybody who I haven't been able to get back to. Please be patient with me. One of the things I definitely want to make sure of is that when we have a conversation, just let me know your time frames. Let me know what your actual desires are, what you want to accomplish. I can help you to accomplish what you want to accomplish and even put you on to different businesses that may not cost you something. We're here to really help you guys to make income, to take care of your families, to not have to be terrified of all the different woes that this financial system puts upon us because we just don't know, or we've been misinformed that, hey, this thing over there is bad. No, this thing isn't
That's right.
bad. This thing is what wealthy people use, and this thing they keep trying to legislate to not be as beneficial as it is. So that should tell you something, right? And so that's what we're here for. We're just here to help you guys out. So continue to check me out. Of course, once again, I have to also mention the charity. The Light the Night Lymphoma.
I'm gonna leave all that in the description box for you too.
Yeah, check us out there. Please, contribute on behalf of that as well, man. And I appreciate you guys' time. I appreciate all of the wonderful conversations I've had with every single person.
DeAndre said it at the beginning of this podcast. The revolution will be televised. And honestly, all jokes aside, man, if you don't know, you ain't gonna grow. So you got to be in the know to grow. So this is how you become educated. This is how you stay in the know in order for your bank account to grow. And that's what we're here to help you do, right? And I hope that comes across genuinely from us, because that's what we're trying to do here on this platform. Listen, I appreciate you guys very much. Looking forward to the next one, and I'll see you guys then. Peace.